Good morning from London. This is Bloomberg Markets Today. I'm Kriti Gupta alongside Tom Mackenzie and Lizzy Burden. With the cash trade just less than an hour away, here's what you need to know. Nvidia plans to upgrade its AI accelerators every year, unveiling the Blackwell Ultra chip for 2025 and next-gen platform Rubin for 2026. Meanwhile, France gets a credit downgrade as the budget deficit looms large over its economy. Over in the States, a slew of economic data may reveal early signs of a slowdown. Plus, CEOs and regulators of the world's largest airlines gathering at the IATA AGM in Dubai. We're live on the ground with the latest on supply chain issues and the demand story.
It is a risk on for these markets. A very solid Asian session, some China data coming through, manufacturing improving, it seems, at least around the edges. But it's the Nvidia catalyst coming through and also digesting that slightly softer inflation print out of the US on Friday. European stocks looking to add a full percentage point at this point in the session, at least as we lead up to the open at 8 o'clock UK time. FTSE 100 looking to add 68 points. The 10-year benchmark at 448 after there was a bid for treasuries on Friday on the back of slightly softer and cooler inflation data. Eurodollar at 108, a big week, of course, for that currency, with the ECB expected to cut for the first time in this cycle on Thursday. Markets Today starts right now.
Well, good morning. We're thrilled to have you here. There's a plenty to digest. We're going to get right into it. We're talking about plenty going on this week. We've got the ECB, we've got IATA, we've got super return. We have plenty of coverage right here on Bloomberg. But I think we have to evaluate what happened in the last 72 hours before we talk about the next 72. We've got PCE data, we've got a French downgrade, we've got Nvidia making headlines yet again. Just when you think that the bar is already too high, Nvidia beats it once again. I don't even know where to start. Tom, let's start with the macro first.
Yeah.
The PCE story. We're starting to get cracks. It feels like early cracks, at least in the narrative around that U.S. economic resilience story. What did you make of it?
This is what happens when Kriti Gupta is taken out of the U.S. consumer bucket and is
all my money's going towards Spain.
To the UK. So it's an uplift for the UK and the Eurozone. Yeah, look, this is really interesting. I think one of the lines crossed, and we've done a deep dive on the health of the US consumer on the back of this, some really great reporting from Bloomberg and the team. But it's the saving rates that really stood out to me in terms of that 16-month low. But yes, top line, look, it came in, top line, the headline came in line with expectations, month on month, a little softener. This seems to be what the Federal Reserve wants to see. But again, you're going to go back to comments from Federal Reserve officials saying it's not just going to be 1 month or one set of data. We're going to have to see this a number of times to get that conviction, to have that confidence that inflation is heading in the right direction. But top line, it seems to me this has to be a line, a win, at least a tick in the box for the Fed.
Yeah, interesting to see the market reaction. Of course, it was the end of the month,
yeah,
at the end of the week last week, and you had the S&P ending with its best month since February. I mean, it was only May, but there you are. It spiked in the last 20 minutes of trading. An interesting stat from Goldman. So if you go back to 1950, there have been 21 years the S&P was up more than 10% by the end of May, of which only twice did it end down. So things looking up for the S&P.
Yeah, it's really interesting. And then you put that, that's the kind of the U.S. story as we talk about the data and whether or not the stock market's actually listening to the data, or whether they're kind of building on this idea that the Fed may, not be cutting, what that narrative, what that connection or disconnect actually looks like. To me, the story in Europe was all about that French downgrade. You've got a G10 economy getting a credit downgrade from S&P. It hasn't been priced into the markets yet because the markets weren't trading when this came out, I think Friday night U.S. time, talking about these budget deficit concerns, that it's only going to get higher. Yes, they're going to try to hit that 3% target. We know Bruno Le Maire has been talking about this, but it's still not going to get there fast enough. So therefore, S&P saying, we don't believe you.
You're almost relishing this downgrade of the French sovereign, it seems, Kriti.
I'm not relishing it, but...
it's right to point out, this is obviously a blotch on the record of Macron. At least that's how it's going to be spun by his political opponents. His own team will say, look, there was the COVID spending, there was the energy spending. It's the kind of narrative we hear in the UK as well when it comes to addressing that debt question. You may be able to draw some links, Lizzy, because you look, of course, at the UK in great and granular detail. But this is clearly a not going to challenge for President Macron. But there's a broader story here.
Well, what he has in common with Rishi Sunak is that he's going to the polls fighting on his economic record. If you look at the stats, the deficit as a percent of GDP has been running wider than the 3% target since COVID. And then if you look at the polls, he's trailing Marine Le Pen as we head into these European elections. So you can look at the market reaction when we get French bonds trading, but this is already being seen in the politics.
Yeah, and this is going to be something we watch very closely, especially ahead of the EU parliamentary elections as well. What is the read-through there? We should talk about OPEC, but I think we're going to do a little bit of a deep dive later into what that market market reaction is. You mentioned as well that Brent crude is moving, but again, it's still at that $80 a level on Brent. So we're going to keep an eye on the deep dive there. But let's talk about Nvidia for a second and circle back to the stock market. Lizzy, you were talking about that massive move you saw in that late session. There's a volume story there. I think our producer Dan Curtis said May 31st historically tends to be a heavy volume day. You're the nerd on tech, though. Talk to us about this Nvidia story. They keep raising the bar.
They do. So they come with an update. I think what's really important, what we're learning from this, is that this is a cycle now. This is a yearly cycle. This, for me, was the headline and the clarity coming through from Jensen Huang. He talks a good story. He has a really great story to tell about the AI revolution. But the top line was, we are in a cycle now. Every year, you're going to get an upgrade from Nvidia, and its competitors are going to try and keep up, the likes of AMD, for example. There had been concern that you get a bit of a gap. There's the H100, is what they're sitting on right now, and the Blackwell, which comes on the end of this year. There was concern, some reporting suggesting that some of their buyers were going to be holding back. That hasn't come to pass. Maybe that's a challenge for them next year. But the fact that they're upgrading so quickly, so swiftly, not just on the hardware, but the software as well, I think is really consequential. And its competitors are going to try and add to that.
Yeah, of course, the bigger point here is that they're trying to broaden the customer base beyond the cloud computing giants. And it's no coincidence, of course, that they made this announcement in Taipei. There's a nice line in the story that the path to AI breakthroughs is paved with semiconductors and servers, many of which are made and assembled in Taiwan.
Well, you know what's interesting about this kind of design cycle as well is I'm having a little bit of deja vu around Apple. Isn't this the concern around Apple is that the design cycle is every year. So if you were to hypothetically, they don't do this anymore because there's a little bit more delayed. But initially it was you have a new iPhone every year and it cuts, you kind of cannibalize your own demand. And I'm curious what that does for Nvidia. If you have that same thought process, could there be an argument that says, all right, we're not going to upgrade our AI accelerators now, we'll do it in a year's time, and it won't make that much of a difference in terms of the impact? Do you think there's that concern?
Well, that doesn't seem to be today's story, but clearly there has to be a risk for them going forward as CapEx spending plans adjust and change. He's pointing out the efficiencies that are gained with each new derivation of these chips. And the efficiency inputs and outputs, I should say, and gains are significant just with each individual upgrade. So there will be that argument from some CFOs to say internally, hang on, let's hold on. But we're not seeing that happening, at least for now, on the numbers that we're getting from Nvidia. Yeah,
and we're going to, of course, keep at the European Open what that read-through actually looks like. Because there has been that read-through in the ASML story, even Infineon, for example, sometimes. But then there's have been some days where it hasn't. I think that speaks more to the momentum around Nvidia as well. So we're going to be monitoring that into the Open, monitoring that throughout the rest of the week as well. You guys are not going to believe this. As I was reading into what was going on this last weekend, I got a message from our very own Guy Johnson on location in Dubai with, you will not believe this, videos and pictures of Enrique Iglesias performing in Dubai at the IATA conference.
What is it, a 4-year-old children's party or something like that?
I believe it was a professional event, but we'll have to ask him because as I was...
Guy's becoming a fan.
I'm convinced. I'm convinced. I keep trying to say I told you so. But he, of course, is covering that for us. And we should go to that story, not the Enrique one, but the IATA one. IATA's Director General says supply chain issues that have held up the delivery of new aircraft around the world could stretch into 2026. Now, speaking to markets today, Guy, at the association's annual meetings in Dubai, Willie Walsh also weighed in on the state of the consumer.
I think remains quite robust. It's recovering slower than we had expected, principally because of the Chinese market in terms of international travel to and from China. But I think that's a timing issue, not a plateau. I think that market will continue to recover and get back towards 2019 figures, but it'll take a little bit longer than we had expected.
And our very own Guy Johnson joins us from the ground in Dubai. Now, Guy, aside from Enrique Iglesias, what's the latest out of IATA?
Well, OK, so let me tie this all together. Kriti, we often talk about the Taylor Swift economy. We talk about the experience economy. We talk about the Enrique economy, dare I say it. People still want to travel, and that demand is still really strong. You can take a look at the data you saw out on Friday out of the United States, and you look at maybe a consumer that is slowing down. But I have to say the CEOs that I'm talking to here are seeing no sign of that right now. I talked to Ed Bastian from Delta Friday. He was making the point that their upper-end consumers are still spending and spending strongly on travel right now. I've spoken to a bunch of Middle East carriers over the last 24 hours. Tim Clark, we've spoken to Etihad, Emirates, we've spoken to Etihad as well. They're talking about strong consumers as well, still being there. So this is an industry that is not at the moment seeing a consumer that is rolling over. The Enrique economy is still live and well and continuing to perform. The issue this industry actually faces is the issue of the availability of aircraft. They're still struggling with what is happening with Boeing. They're still struggling with Pratt & Whitney engines coming that go on to Airbus aircraft. But in some ways, what this may do is actually throttle back the availability of new aircraft and actually mean that the cycle for this industry lasts a bit longer. There you go, you see, I tied together Enrique and aeroplanes. What more can you want?
Guy, I literally don't know what you mean about the Enrique economy. You and Kriti are the only Enrique fans I know in 2024. So I'm going to breeze past that and ask you what other interviews you've got coming up for us, because I know you're going to be busy.
We've got some great interviews coming up. We've already spoken to a whole bunch of CEOs already. We're speaking to Ben Smith. He is the CEO of Air France-KLM. There's a consolidation story that we need to talk about here in Europe. What's going to happen with businesses like ITA and TAP in Portugal, ITA in Italy. We're going to talk to Ben about that. The Olympics is coming up as well, talking about the experience economy. That's going to be a big story as well this summer, along with the football here in Europe. We're going to be speaking to Shai Weiss, the CEO of Virgin Atlantic as well. He promises me, I saw him last night. He was there watching Enrique as well. He promises me that he's going to have some news for us. So we'll break that a little bit later as well. And we're going to be speaking to Scott Kirby. He, of course, is the CEO of United. He's had a lot of things to say about Boeing over the last few months and the problems he's experiencing as a result of those supply chains. So we'll get some more from Scott. Also more from Scott on what's happening with that demand story as well. So some really great guests lined up throughout the day, giving us an idea of what's happening both on the engineering side but also on the consumer side globally.
All right, lots to cover. Markets Today anchor Guy Johnson, we miss you. Enjoy that Enrique for us. We thank you, and we'll come back to you later in the programme.
OK, let's take a look at what... I don't know where to go from here. What else is on your agenda this week? All right, Monday, we're going to get more details. Of course, Guy is on the ground for us in Dubai. He's got a really fantastic lineup, he said, of CEOs from the airline industry to continue to keep a gauge of how things are evolving in that space. Also, later today, EU and US PMIs as well. So adding on to the picture around the health of these economies. Tuesday, the Berlin Aviation Summit, the Super Return International as well. So a zeroing in there on the world of private equity and capital as well on Tuesday. Wednesday, we're going to get central bank decisions from the central banks of Canada, Kenya, Poland. We're also getting earnings from Inditex, Volvo and Lululemon. And on Thursday, it's the big one, the ECB decision, of course, expected to cut for the first time in this cycle. Also, the voting for the EU and citizens across the EU with those parliamentary elections. And on Friday, the US jobs report, non-farm payrolls coming out on Friday, seeing how that adds to the picture when we see slightly softer and slightly cooling, at least in the margins, inflation and a US consumer. RBI rate decision as well on Friday, and the ECB speakers, including Nagel, Holtzman and Schnabel. So their commentary after that ECB decision will be really interesting in terms of where that central bank goes from here.
Coming up on the programme, we're going to go live to Riyadh, where the OPEC Plus meeting's been happening. Ministers agreeing to extend production cuts, but also laying out a plan to bring back some barrels. We'll dive into that. We'll also dive into the markets with JP Morgan's global FX head, Samuel Zeef. But up next, the latest from South Africa, where the ANC's started talks with rivals to form a government after failing to win a majority for the first time in 3 decades. If you've got any questions of your own for our guests, do please send them in on IB Plus BBTV Go. We've got plenty more for you. This is Bloomberg.
Now, there's plenty going on in the election space in the last 72 hours, really at inflow. South Africa, Mexico, India. Now, there's a lot going on in terms of the geopolitics here. This is the year of elections after all. But what does it mean from a currency perspective? For South Africa, we've had full coverage. Jennifer Sabasaja leading that on the ground, talking a little bit about what a coalition actually means for investors in the rand. And there has been this kind of series of outflows that we've seen quite a bit in the bond market, in the equity market in South Africa as well. This idea that even though it is the juiciest yield in EM right now, when you look at the bonds, South African bonds, there's still concern about what the future of the country looks like. But then again, if you're willing to take on the risk, the rand.
But the uncertainty is certainly there. Rand is up 0.2% versus the US dollar in the session today, the first time in 4 sessions, as maybe they get a little bit more detail. And again, the ANC suggesting they are working to put together that coalition. The question is, with who? Yeah. And if they pull together a coalition, it seems, with the party of Zuma that was only set up, 5 months ago and took this, almost 15% share in terms of the vote, then that may lead to some concerns. If they form the Democratic Alliance, then that seems to be more investor-friendly. So where they land in terms of the coalition seems to be key. But for now, at least, there's a little bit modest relief coming through for the rand. Yeah,
and the question being how much policy continuity you get, which is the same question that you have in Mexico. We have had the president congratulating the new president on an election win. I thought it was funny to see that the old president said he'd retreat to his ranch now. Will he actually? Because one of the worries is how much he keeps his finger in all the pies of policy, and it's hard to kind of get rid of that influence over who is now going to be Mexico's first female leader.
And one of her major policies, and I think this actually connects quite nicely to India as well, which we're also watching, is what does relationship with the states look like? Great piece in The Economist over the weekend about what that Trump dynamic looks like. We know that migration has been, of course, an issue. The border has been a big issue as well, not to mention what exports actually look like in the face of a trade war with China, or a magnified trade war in a Trump 2.0 or even a Biden 2.0. Do those trends around nearshoring, et cetera, really amplify the likes of India or Mexico, et cetera? And you've seen that on the corporate level to some extent. But let's go, of course, back to that political story. Jennifer Sabasaja joins us with the latest live from Johannesburg. Let's bring us in now. Jen, walk us through what investors are watching now that we actually have this election result.
Right, Kriti. I mean, this is really, as one investor put it, a fork in the road for this country, because, yes, we now know that the ANC got just over 40%. But the question is, now if they are meant to and they need to form a coalition government, who is it that they are going to team up with? So going into the election, the most favorable outcome for the ANC to partner up with a party would be the Democratic Alliance, potentially helping them with their policy continuity, more business-friendly policies. But, you know, potentially they could look to former President Jacob Zuma's party, as you can see there, did surprisingly well in this election. But the issue here for the ANC is that the MK party has demanded that the president step down, and the ANC has said no. So investors are really watching closely for what these discussions that are beginning today are going to look like and what it will mean for policy continuity here in South Africa.
OK, Bloomberg's Jen Sabasaja on the ground for us in Joburg. Thank you very much indeed, as we continue to watch the coalition talks, of course, with the ANC and some of those potential partners. On the FX space, let's bring in Zam Seif now, head of global FX strategy at JP Morgan Private Bank, for a deep dive on the space. And look, we want to get your speciality, of course, in terms of G10, in terms of the dollar and the euro. But before we go there, broadly on EM, and there are some idiosyncratic stories that we've been unpacking there around Mexico, India, South Africa. Is there an appetite amongst your clients and your colleagues to get more exposure broadly to EM, or has the door closed to that trade?
I think the most important thing that we think about at the private bank is not painting EM with a broad brush, right? That you don't have to have a very large allocation across every single country in EM. And when we think about it, we really try and identify the stories that we think are longer term, are structural, and that offer our clients kind of very attractive returns, whether it be from the equity space or from the bond space. And importantly, because of the countries that we're talking about today, it's really inflation-adjusted returns. And so India, I would say, if we're thinking about Asia, is one of those areas in emerging markets that we do think offers our clients really good equity exposure, particularly if they're thinking about Indian equities versus Chinese equities. We've been looking at that relative value for a long time. When I think about the FX and bond space, and we're thinking about the countries that we're talking about today that had elections, Mexico is a place that offers very, very high. Kriti, you mentioned that South Africa has the highest nominal returns on its bonds or yields, but Mexico has the highest real returns on its bonds. And that's what we really care about from an FX and bonds perspective. Where we've been watching the election has really been, at least from that perspective, is there anything being injected into the situation that is going to derail what's already a very positive story from a real return perspective in Mexico? Everything that we've seen, at least over the weekend, is a no. So we continue to think that Mexico, at least from, again, inflation-adjusted returns and FX perspective, is one of the best places to be in emerging markets if you're looking for those opportunities in EM.
Well, as we're talking politics then, how vulnerable is the US dollar to domestic politics, to US politics?
Yeah. So we do watch this very, very closely, and there's a couple ways that we can try and identify if there's any risk premium being built up in US assets ahead of the election. As of right now, if we think about just modeling the dollar against growth expectations or interest rate differentials, the fundamentals that should dictate that, if anything, the dollar looks maybe 5–10% too strong on those metrics. We'd expect that to really invert if all of a sudden there was increased fiscal risk premia or any type of political risk premia in the dollar. And so as of now, no, we're not really seeing anything like that. We do pay attention to it. If the dollar is going to weaken in our minds, it's going to be because of cyclical reasons. The U.S. economy slows. The Fed interest rate cutting cycle really comes into view. We think that can happen for cyclical reasons, but to us, that's kind of a late 2024 into 2025 story, not so much over the summer.
All right, let's bring it back to the G10 story, if we can. We're talking about the dollar. We're talking about it being at the whim of these elections. I'm obsessed, though, with the deficit story. We saw it with France getting downgraded on Friday, really talking about this budget deficit looming over their economy. It's a similar story in the States, especially post-election. It's the first thing that comes up for the new president. And I'm curious why the FX market isn't reacting to that, or perhaps is in terms of fund flows. What does that look like?
Yeah. Look, it's one thing to say that the U.S. fiscal trajectory is concerning, maybe unsustainable, if I can use that, over a very long-term horizon. But the dollar, you can't deny it, is at the very center of the global financial system. Yeah. And so whether we look at the dollar share of global foreign exchange reserves, over 80% of financial transactions just globally are conducted in dollars. 60% of global trade is invoiced in dollars. Because of the dollar's central role at the financial system, the U.S. gets a much longer leeway, right, for maybe in another country that had the same level of fiscal deficit, the same external deficit. If we think about that twin deficit in the UK, it looks very similar to the US, but we'd probably see those types of concerns start to show up in the UK before we start to see it in the US because of the US dollar's role in the financial system. And so those are the types of things that we're trying to kind of parse as we look at this for our clients.
Sam, I'm glad you brought us neatly onto the UK. I'm assuming you're assuming it's going to be a Labour victory on July the 4th. I'm wondering how small a majority the Labour leader Keir Starmer would need to win in order to knock the pound.
So I don't presume to know anything about it, but the polling certainly looks in that direction. Look, I just think that the next government in the UK, regardless of who it ends up being, is going to be very fiscally constrained, right? And I think those are kind of the lessons and the scars learned from what we saw in the fall of 2022. And so we're really not expecting much in terms of fiscal expansion. If anything, there will probably be some fiscal consolidation. I don't think the political victory, one way or the other, is going to knock the pound, right? What we're really focused on, I could apply the same type of analysis that we look at for the dollar. Are we starting to see signs that the pound is trading either weak relative to fundamentals or vice versa? And no, the pound looks almost exactly at fair value when we think about cable based on interest rate differentials and global equities. If we started to see some of that premium start to build up, then that would tell us something about what the market thinks a Labour victory might mean versus a Conservative victory. Yeah. But honestly, the polls have been so consistent, and the fact, I mean, I don't think I'm going out on a limb by saying that the polls have been so consistent that the market's base case is probably a Labour victory, and still you have not seen any signs of risk premium build up in the currency.
Is that the reason, though, for this low vol dynamic we're seeing in FX broadly? Monetary policy seems to be on ice. Elections, we're waiting for them to roll out. Even if there are volatility in the elections, there's really no room in budgets to do anything. What changes the vol picture in FX?
Yeah, I think it's global growth, to be honest, right? If we think about what's happening in the global economy, there's really two things. One, global growth is actually improving. Even though rates are at these levels, global growth is kind of based from the second half of last year and is improving. And what we tend to see when global growth is strong is volatility is low. At the same point, the tail risks to the global economy are really coming in. So you have strong growth, but because labor markets are cooling and inflation is coming down, there's no need for central banks to hike rates and destabilize it from the right tail. And so you have the left tail and the right tail coming down. Right. If something was going to inject volatility, I think, sustainably into markets, I think it would be a real significant cool down in global growth.
Certainly something we're going to be keeping an eye on. Samuel Zeev, head of global FX strategy over at JP Morgan Private Bank, really taking us on a tour of the world. We thank you so much. Coming up on the program, we're going to talk about private equity. The CEO of Pemberton Asset Management coming up next. This is Bloomberg.
Welcome back to Markets Today. Happy Monday. 30 minutes, of course, from the start of today's trade. And European futures are pointing strongly higher, pointing up by a full percentage point as things stand. US futures also in positive territory, up 0.2%. A redhead crossing the terminal right now. Saudi Aramco courting foreign funds with a roadshow in the US, an international roadshow. Top executives apparently set to hold a series of events here in London before moving to the US to try and drum up demand for the oil company's $12 billion share sale. That was 5 years after it scrapped that international roadshow for its initial public offering, its IPO, of course, 5 years ago. So it seems like they expect that there's going to be more foreign demand for this share sale offering from Saudi Aramco, starting in London, then moving to the US.
Indeed, and speaking of courting Middle Eastern money, Pemberton Asset Management's announced a $1 billion net asset value financing strategy, which is going to be anchored by the Abu Dhabi Investment Authority. Now, financing, of course, has been considered a controversial form of financing as it lets managers layer more leverage on their funds late in the cycle. But Pemberton says it expects it to become a core tool for private equity managers. So we can discuss this now for an exclusive conversation with Simon Drake-Brockman, CEO of Pemberton Asset Management. Great to have you with us in the studio.
Thanks very much.
I mean, what's the significance of this deal with the Abu Dhabi Investment Authority for your net asset value financing strategy?
I think ADIA has been one of the bellwether investors globally for many, many years and has been at the forefront of new asset class growth in the private markets. And I think there's been a lot of discussion about NAV financing over the last 12, 18 months as private equity has slowed down to a certain degree and was this being used for structural engineering. But I think this is really an endorsement by ADIA of what is going to become one of the key financing tools in the private markets. And particularly if you look at our strategic NAV financing, it really creates tremendous alignment between the private equity firm and its LPs, because in many cases, they're actually borrowing money against the fee income of the manager to put that money back into funds and to align themselves with their LPs. So I think it's great to have the endorsement of ADIA, one of the most sophisticated investors globally inside the asset class, and also one of the largest private equity investors globally.
So can we expect more partnerships like this with Middle East sovereign wealth funds?
I mean, clearly, as we've gone through a challenging 18 months of capital raising in private markets, the Middle East has been a huge focus for investors and general partners in that space. But I think, what we've seen is a recovery in demand from institutional investors coming back into private markets as they see the relative value in private markets has opened up again. And therefore, I've been on the road for the last 6 weeks talking to CIOs around the world, and I think they're very, very focused on private markets because they've seen how well they've performed over the last 18 months.
There's been some frustration, however, among hedge funds, for example, who have allocated to alternatives, wanting to chase that yield, but then ultimately not being able to get that return fast enough. It feels like the return is slowing down a little bit, and they're not able to deploy that equity into the public markets then, especially when right now they're rallying. Talk to us about that. Is the market getting a little bit too saturated? Are there delays? Where are the cracks in this really record move into the private markets?
Yeah, I'm not sure. Hedge funds coming into private markets, to me, can be a bit of a misalignment. Hedge funds are vehicles designed to be able to move very, very quickly and to have investor liquidity in and out of the vehicles. Yeah. If you look at private markets, it's really term investing designed for institutions who want to have long-term appreciation in their portfolios. So, very well designed for pension funds, very well designed for insurance companies, etc., who have long-term liabilities and want to lock in those returns. I think going back to the ADIA story, why is ADIA coming to Europe? Europe is, you talked about potential rate cuts and the growth cycle coming back into Europe. But I think one of the things people miss is that Europe's still in a very early stage of sector consolidation in the mid-market. And private equity has brought $1 trillion of capital into Europe in the last decade, particularly focused on the mid-market space, because you've got these family-run businesses which are going to be consolidated into much larger mid-market companies, similar to what we saw in the United States 20 or 30 years ago. And that way, For the investor who's got 5-10-year investment horizons, this is going to be an enormous opportunity. And if you look at the yields and the structural protection that the deals have got today, it's extremely attractive for investors like ADIA and long-term investors in the market.
So let's talk about the deal structure here. Lizzie was talking about the NAV financing in particular. You're seeing that become a growing trend, but met with growing concern as well. You're also seeing growing trend in payment in kind, for example, or synthetic payment in kind. These are all fairly risky structures. Do you feel like to attain more of that or to have more longevity, the benefits or the discounts being involved inside some of these deal structures is growing?
I think you've got to separate the large cap buyout market from the mid-market. So there's no doubt that the large cap buyout market has been going through an adjustment. Valuations got very high, a number of deals were done, and now those deals potentially are going to take longer to exit, and some of them have come under financial pressures as rates have moved so substantially, and there's been some pressure on EBITDA. I think if you come down into the mid-market where we're operating in the platform that we've built across Europe, that market is still in growth mode. And what you're seeing is private equity firms coming in, buying initially a platform and then doing significant consolidation on a pan-European basis. And that's really bringing customer bases together, developing platforms around outsourced business services, technology, healthcare. If you look at the healthcare industry in Europe, it's massively unconsolidated compared to the United States. But these are still much more smaller regional businesses than what you see in the United States, where you have these very, very large healthcare companies on the East Coast, in the Midwest, and in the West Coast of the United States. And that's where, private equity's got a huge opportunity. But if you go back to the NAV financing brings in the opportunity for those private equity firms to differentiate their financing structures. So you've seen GP stakes grow tremendously over the last decade, but you have to give away a third of your firm, for example, in that transaction. That doesn't necessarily create as much alignment, where if you look at NAV financing, you can bring the capital in, you can secure it against your historic GP investments or your income coming off the funds that you're managing, and you can take that capital and you can put it into the funds right beside your LPs, and then you're incredibly well aligned. So I think some of the perceptions around NAV financing is misaligned, and any new asset class, when it starts, there's always a lot of skeptics in the process. I remember when subscription lines started 10, 15 years ago, everyone was highly critical of subscription lines. Today, 90% of funds have subscription lines because it actually helps the LP in managing its cash flows in that process.
What level of distress are you seeing across your portfolio in this higher rate environment?
Listen, I think everyone has been very pleasantly surprised from an investor point of view of how well portfolios have performed. And I think that's really been driven by two things. I think firstly is if you go back to 2006 and when we went into the GFC, private equity was putting in 25-30% equity and borrowing the rest of the money. Over the last decade in the mid-market, private equity has been putting in 50-60% of the money. And so there's a much bigger cash buffer inside the company for the adjustments that we've had to go through with inflation and also interest rates. And then the second part is, particularly in the mid-market space, this is genuine growth. This is adding customers, refining businesses, taking them from family-owned into private equity-owned, where they can streamline costs, think about distribution channels in a more powerful way, and actually increase the value inside the company. So I think if you look at the markets today, the leading players like ourselves, have gone through the last 24 months with modest pressure inside their portfolios. And where there has been pressure on some of those companies, private equity has stepped in and put more capital into the companies to help them through that adjustment period. So performance has been strong. I think it will continue to be strong. And we're through the worst of the rate cycle, and we're certainly through the worst of the inflation cycle. Rates will be higher for longer, as we've all seen. But I think the industry is in a good position.
OK, Simon, thank you very much indeed. Just briefly on AUM, you said you had a target back in 2022 of 50 billion. Are you confident on that target? When do you get there?
Yeah, well, I suppose, people don't like to predict exactly in there, but I think we're on target over the next 2 or 3 years to hit that number. Okay. And so we're growing very rapidly, and I think there's a lot of capital coming into Europe.
Simon, thank you very much indeed. Really interesting take on what is evolving in this private credit space, private equity space. Simon Drake-Brockman, CEO of Pemberton Asset Management, also on the deal with, of course, Adir of Abu Dhabi. Kriti.
Yeah, we're going to be continuing the private credit, the private equity conversation. I'll be live in Berlin alongside our very own Danny Berger at Super Return International. It's the world's largest private equity event kicking off tomorrow. We will, of course, be live on the scene Wednesday and Thursday. We've got a great lineup there. You don't want to miss our interviews. David Hirschman of Permira. We've got the folks over at Morgan Stanley, Goldman, Bain, and, of course, Rachel Arnold over at Vista, which is the one I'm extra excited about. Karen Norton, got some VC in there from Silicon Valley as well. There's a lot to digest. We're going to talk about the cracks in this market, the opportunities in this market, and again, some big names as well. Danny's, I believe, got Apollo, KKR. We're very excited about it. You do not want to miss that. Coming up on the program for today, though, OPEC Plus extending some cuts, but laying out plans to bringing barrels back. We're out to Riyadh, where the meetings took place. That coming up next. This is Bloomberg.
We're about 16 minutes away from the open. You've got futures pointing to a higher opening here in Europe. But before we get there, let's look back at the weekend. We had that OPEC Plus meeting setting out a plan to restore some early production as soon as October. But there are also concerns about the demand outlook. You've also got robust supply from beyond the group. So let's break it all down. We've got Bloomberg Horizons anchor Jumana Basecci in Riyadh for us. Jumana, is it fair to say that the winner of the weekend was the UAE?
That it certainly is one of the market's assessments from what we got yesterday, a series of announcements. And of course, UAE seems to be the winner because their own production capacity was increased by 300,000 barrels a day in 2025. But the big takeaway here is twofold. The first is that the group cuts were extended all the way to 2025. So that's quite a long time horizon. And then those so-called voluntary cuts, these were cuts introduced in November 2023 by only 8 of the producing countries in OPEC, including Saudi Arabia, Russia, UAE, all of them who actually descended to Riyadh yesterday for this meeting. There we got a little bit more granularity on what they're expecting to do with those voluntary curbs. And so we found out that they're going to continue with those curbs until the end of the third quarter of this year, after which, so from October of this year, they will slowly start putting more barrels back onto the market again. And so there was a lot to digest here. And I think the complex nature of the announcements with the quotas and the various baseline levels took a while for the market to sort of piece together. But ultimately, we are looking at OPEC potentially putting more barrels onto the market by the end of this year. And then here comes the big caveat. They say subject to market conditions. And that, I think, is a key element that investors need to bear in mind, because if things don't pan out the way that they would like, then they will likely continue to keep taking off these barrels from the market. And over the summer, you want to look at demand and seasonality. Typically, the summer months are very strong demand months for oil. You want to look at the inventory situation. We've spoken about U.S. inventories continuing to move higher, which acts as a bit of a cap to the market. And then finally, the macro. We spend a lot of time talking about the Fed here. If the Fed actually do start cutting interest rates, that could be supportive for the sector as well. So still a lot of question marks over the next couple of months and how this oil complex is going to look.
Yeah, clearly a lot of different factors that they have to weigh up. Meanwhile, and I know you were looking at this as well, Jumana, Saudi Aramco successfully selling, a $12 billion stake in that business. What do we take from that, what appears to be pretty solid appetite for that business?
Yes, that's right. So it's all kicking off in Riyadh. Yesterday, Saudi Aramco did actually open the books for the secondary share sale. They're looking to raise about $12 billion. And according to our reporting over here, Matthew Martin, he put out a comment yesterday saying that in the very few hours of those books being opened, they managed to satiate all of that $12 billion in demand already, just on the first couple of hours of that book being open. But we do know that they're going to keep on with the book book building process throughout the course of this week. Matthew just put out an article now saying that a roadshow is currently taking place in London. The CEO of Aramco, Amin Nasser, is flying there alongside the CFO. And this is all part and parcel of their attempt to attract as much as international investor demand as possible. If you rewind back to the original IPO back in 2019, their investors had a lot of questions about the ultimate market cap, about the dividend prospects from Aramco. You fast forward to today, and they've been really heavily leaning on to the fact that they pay out quite a juicy dividend, much higher than some of the other oil stocks out there. Whether or not that's enough to bring in the international institutional demand is going to be a big question mark, but the book building so far has been quite constructive.
Certainly something we're going to be keeping an eye on. Jumana Bersachi joining us from Riyadh. We thank you so much for that crucial context. Let's get a little bit more of a market's perspective here, because there is seeming to be a lot of news coming out of the Middle East. The oil story is really very interesting. Let's dive into that a little bit more. Paul Dobson, our executive editor for Asia Markets, joins us this morning for our morning minute, or our market minutes, excuse me. Paul, let's start with the oil story here. We're talking a little bit about these OPEC cuts, which again were largely priced in the markets. A little bit of a shocker there, but you are still seeing Brent crude at $80 a barrel. How much of a difference does this make to the macro picture?
I think that any signs of weakening crude prices is generally a positive for the global macro picture at this point, not least from an inflation perspective. If it's one more thing that's cooling in the global economy, then that's going to feed through into prices at the pump, and that's going to be good for consumers of gas and related products as well, so long as it's not too much of an indication of really bad demand and bad economic growth. I think what's interesting about China in particular is while refinery runs are slower and there isn't that much demand or consumption, part of it is because of the big change that we've seen in the makeup of the industry and in that big rollout of electric vehicles that everybody's talking about. So it might not be entirely as negative from that sort of demand section as you might otherwise think. So a couple of things to keep in mind there. But in general, you know, if we are going to get a little bit more supply coming back towards the end of the year, then that should cushion the pressure on oil prices, and that should be one more feather in the hat for those trying to bring inflation back down to target.
So in the context of that inflationary story as well, we've got plenty of election coverage, but kind of monetary policy sitting on ice with the ECB meeting on Thursday as well. Paul, where are the cracking points in the FX market right now?
Oh, boy. Well, I think the ECB is going to be really interesting from the perspective of, yes, everybody knows it's been very well telegraphed. They're planning to cut, but how many more cuts are they going to be inking into their forecast for the rest of the year? And how fast is that cut going to look relative to what the US is going to do, what the BOE is going to do, and how that can shake up things in the FX market? But, you know, the frailty, the fragile point really is still on the other side of the world, the place that isn't hiking particularly quickly and has much lower interest rates than the rest of the world, which is the yen. We still see that under weakening pressure. We see those fractures, and if that volatility starts to blow up, then that could be the thing that upsets the rest of the market.
All right, Paul Dobson, our executive editor for that Asia market story. We thank you so much. We want to continue the conversation. We're doing a tour around the world, oil, FX, and now we go to the stock market picture. Joe Easton standing by from our equities team with our stocks to watch. Joe?
Morning, Kriti. So we're keeping an eye on the chip stocks today with a lot of excitement around the latest comments from Nvidia speaking at a trade show over in Taiwan at the weekend. They did announce a swathe of new chips and say they will upgrade their AI accelerator chips every year going forward. Now, the CEO was talking up the rise of generative AI, saying it is a new industrial revolution, and they expect every sector, including shipbuilders to drug developers, to all embrace it. Now, we also did see some comments from Advanced Micro Devices as well, AMD, over the weekend at the same conference, but Nvidia really the focus, and we can see, look at that, a 3% gain in the Bloomberg Asia Pacific Chip Index, the semiconductor index. We would expect to see some of those gains following through this morning. We'll bring up the usual suspects, ASML, BE Semi, Ixtron and ST Micro. Pretty mixed year to date for those stocks, judging by those numbers on the screen, but we could see some positivity coming through into those this morning. Then we're also looking at GlaxoSmithKline, a massive blow for this company over the weekend alongside Sanofi. Now, a judge over in Delaware says that GSK and Sanofi will have to face trials over the Zantac drug that was said to cause cancer. It is a heartburn treatment. There are 75,000 suits outstanding. Previously, we saw a Florida judge say that they would not have to face trial over this, but the Delaware judge going the other way, very negative for those companies. There's the 3-year chart on GSK. This was the drop when these claims first came into the news. Has recovered a bit since then, but this, as I say, looking negative. GSK says they will appeal it. We're also looking at the ASCO conference in the US. This is a big oncology conference that's going on at the moment. Lots of drugs, lots of data coming out on these drugs. One of them to watch is Genmab. City analysts like their anti-tumour drug, saying that they had a really strong ASCO weekend and they think the shares will react positively. The anti-tumour drug showing positive results for Genmab over in Denmark. That one could move higher today.
All right, Joe Easton, our equities reporter, with our stocks to watch. We thank you as we look ahead to the Open.
We got to get to one other story that we're keeping an eye on. One I'm very excited about. Kylian Mbappe has officially signed for Real Madrid. The French striker announcing last month that he would be leaving Paris Saint-Germain at the end of the season. The confirmation from Real Madrid comes after it beat Borussia Dortmund on Saturday to win the Champions League for a record-extending 15th time. I was very excited about this. I don't think you watched the game. Did you?
I think you still call it soccer.
I do, but I'm very into Real Madrid, obviously.
Yeah, we need to wring that out of you. Paris Saint-Germain. Yeah, okay, Mbappe. I mean, what a start. And so we continue to watch this move. It's a big move. He's finally signed. Saint-Germain, of course, we know that they're disappointed by his leaving. Real Madrid, I mean, you can give us more football commentary and what it means for the football space of Spain. But yeah, clearly, look, we're going to watch Mbappe. Big deal. Let's hope he doesn't perform for France, though, in the Euros.
Well, I think that was the concern, right? This is France's star player, especially after, was it the World Cup or whatever?
That other
the other tournament that I wasn't paying attention to.
Yeah.
Not the World Series. But that was a question. There was a lot of concern about whether or not he would go to Real Madrid. This is now confirmed. There's a lot of excitement among the people who were watching this. And it wasn't just me. I swear the pubs were full. Lizzie and Tom just weren't a part of that. So regardless, I'm excited. They're not. We're going to get excited about the European Open. That's coming up next. What is the read-through from the Nvidia story? We'll tell you. Stick with us. This is Bloomberg. Welcome back to Markets Today. We're just a few minutes to go until the start of cash equity trading. Now, look, there's a lot going on this whole week. We've got the ECB on Thursday. We've got, of course, the comments coming out of IATA over in Dubai when it comes to some of the airlines, the European airlines in particular. The private credit, the private equity conference is going on as well. Not to mention payrolls and the EU parliamentary elections going into the weekend. So, again, a lot to digest. But when it comes to today's trade, it feels like there may be a little bit of a catch-up trade from Nvidia. We're watching a couple of retail stocks, though, as well. Tom?
Yeah, absolutely. Look, we've got to be looking, of course, at what is happening in the oil space, in the energy space, given what's happening through OPEC Plus, and then the tech stories, you say, Nvidia coming up with that. What's really interesting in terms of the upgrade cycle for these chips, so we look at the likes, of course, of ASML, the lithography machine maker, of course, listed in the Netherlands, as we count down to the open here. But GameStop is another story. The meme stock's back. This time, Roaring Kitty, otherwise known as Keith Gill, he has posted on Reddit, so he posted on Reddit a screenshot of what looks like a $116 million holding in GameStop, plus some options. We haven't verified that, but he also went on X as well and posted a picture of an Uno card, a reverse Uno card. So it talks about the fact that there's still money in the system. There's still investors, retail investors, who want to get some meme stock action. You're laughing, Kriti.
I'm laughing because of the visual.
Is it the kitty?
I see the kitty. Yeah. I see the Uno card. I just never thought I'd be talking about it to the European market open.
Where I'm sat is Tom's face on the kitty's ears. I don't know how anyone could appreciate that more than I am this moment, but it is very, very weird. I'm so glad that the market open is coming for us any moment now so that I can stop talking about Tom and the Roaring Kitty picture. But as you say, we're looking for a read-through from the Nvidia story to the chip stocks in Europe this morning. Do we see it when we get to the market open? It is coming in just a moment, and here we are. So we have got the stock 600 currently higher, 310. 0.2%. The CAC higher 0.2%. The DAX in Frankfurt higher 0.2%. And if we break it down by sector, you've got about 3/4 of them in positive territory. Utilities leading the gains this morning, higher 1.1%. But bottom of the basket is tech, down 1.3%. I promised you a look at the chip stocks in Europe. ASML Holdings higher 1.4% currently.
Yeah, it's interesting. And when we look at the stock 600 as well, as you see those loading, ASML looks like the biggest index contribution, actually.
Tech is now near the top,
it's
gaining 1.3%.
It's driving the market higher, which is interesting. It's coming off the Nvidia story, but I also have to say, we were talking about this massive rise in the last 30 minutes of the U.S. session on Friday as well. Of course, that's going to be a high-volume trade as well. I'm curious how much of this is a catch-up to that, in addition to the Nvidia story.
Or a combination of both,
Perhaps.
Absolutely, given that data seem to confirm that some work is being done for the Fed in terms of wages coming in a little softer, consumer as well seeming to pull back a little bit in the US, and of course the top line in terms of PCE or personal consumption expenditures, that inflation index that the Fed scrutinizes, coming in on a month-to-month basis lower than had been expected. So that all seems to feed into expectations that the Fed will cut this year. The question is how many, and we look across to the dot plot, of course. Travel and leisure, the sector, seems to be at the top of the list right now. Tech is up there, number 3, currently getting 1.3%. Retail also getting a bid. Looking at energy as well on the back of that decision by OPEC Plus, and it is complicated. Jomana Persechi has been breaking it down for us. Energy as a sector getting 1% on the news that OPEC Plus is extending these cuts, but it's going to start to reduce the extent of those cuts from, I believe, October of this year.
Yeah, and I'm going to, let's talk about some of the individual movers. You talked about the sector space.
Yeah.
One of the downside movers is Sanofi, and I think this is a story we haven't quite hit yet, but this is important when it comes to the spinoff that they have of their consumer unit. I think over the weekend, they have the likes of Goldman and Morgan Stanley now getting on part of that deal. This is potentially one of the biggest spinoffs in history when it comes to some of those European deals. Remember, this is the consumer healthcare space. So that is, of course, seeing a little bit of a drop this morning. But so, again, to your point, one of your only laggards in the entire sector.
Yeah, healthcare now bottom of the basket, but still up 0.3%. Every sector in the green now, and tech higher 1.3% as it stands. But travel and leisure leading gains up 1.4%. Must be the Guy Johnson effect over speaking to the airlines.
Yeah, pushing it higher, perhaps. Well, there's a lot to digest, and I think the commodity sector is quite interesting here. And really, the breadth you're seeing in the European market is fascinating, in addition to the UK market as well. Let's just get a little bit more insight here, because someone who's far more familiar with European equities joins us on set. Sam Unstead from our Markets Today blog. Sam, I want to go broad with you first, simply because it doesn't feel like there's a very big market narrative at the moment, besides the catch-up, perhaps, to the Nvidia story. Is that how you're reading it?
Yeah, I think so. I think also, we've had a couple of weeks where markets have drifted a little bit, and they've been glomming onto this, the rate story in particular. PCE data last week maybe took a little bit of the air out of that, and so that drift lower appears to be kind of slightly reversing, but not with any great catalyst. So it's hard to say whether that's going to go much further than it has in the last couple of days.
And Sam, I feel like not even British people were interested in the UK election last week, because of course the Trump story dominating attention, which is perhaps to Labour's benefit, actually, given its internal disruptions. But let me ask you about the UK market. Is it bothered about the election at this point?
Not yet, I would say. I think you're getting pockets of reaction within the market at the moment. So water utilities, for example, there's been quite a lot of political focus on them already. There's been a little bit of a drift lower in shares in even the listed companies beyond the turmoil around Thames Water. I think what we're waiting for now is the manifestos. Once you get the manifestos and you get a real clear idea, at the moment it's kind of piecemeal, so you're getting a question about the banking sector, a question about utilities, whatever it may be. Once that's all in one place, that's when you can get that real assessment of exactly what's going to happen. And at the moment, the fact is the most important one will be Labour's manifesto.
Do we get I mean, the ECB cuts on Thursday is the expectation. Is that a catalyst? I mean, that presumably is priced in to a fairly large extent across European stocks. How are markets? How are you and the team thinking about the ECB and the guidance that we're going to get?
Yeah, I think it has been priced in. Well, it's taken quite a long time to price it in. So the ECB have been quite clear for quite a while now that June is very much in play, and in the last couple of weeks have effectively been saying we are going to cut in June. The markets have only really just got there. So, but when that happens, that kind of takes you to this next leg of the cycle, because there will actually be an actual rate cut. Assuming that they do indeed follow through. And so once that happens, this question again of divergence between the different banks will start to be raised again. I think you could see a little bit of movement, but I think it's really just rolling over into that next leg of the central bank story.
All right, Sam Munster from our Markets Today blog, giving us a little bit of a taste of what we're looking for on the macro front. You get more from him on the and the team on the front page of the Bloomberg UK website, or simply type TLIV GO on the Bloomberg terminal. And in the meantime, let's look at a quick check on some of the heavyweights. Our version of, or our European version, say the Magnificent Seven, we've got the Sensational Six, all in positive territory. And of course, if you look at it from an index contribution level, ASML is driving the charge higher, almost 2% higher on the day. But then you got Schneider Electric as well. And Guy Johnson loves to remind us that even though that is a utility, there is an AI read through here in terms of how they're able to really capitalize on that. So you can really see tech leading the charge higher, even Nestle higher by 0.7%, in line with some of that consumer stock rally that we've been seeing later. So that is your picture from a kind of larger mega cap standpoint. Let's get a track on some of the other individual stocks on the move. Joe Easton has that story. Joe?
So we have just got an opening price on GlaxoSmithKline. It's a big drop. We're down almost 9%. That is literally just open because we had a delayed opening because it was such a big move. As we said in Stocks to Watch, they will face potentially 75,000 claims that the Zantac treatment caused cancer. That's after a Delaware judge said that they would have to go to trial. We're also seeing that weigh on Sanofi as well. There was, of course, the other story about the spin-off that you guys have been discussing, but Sanofi is also subject to a number of these claims as well. Both companies are saying that they will appeal the ruling, but that is by far the worst performing stock in the UK and I think in Europe as well. We're looking at some other pharma stocks though as well. AstraZeneca and Genmab, two of the companies that have had strong data out of the oncology conference that's going on in the US. We saw Citi calling Genmab higher. We are seeing that stock up almost 4%, and we are expecting to see some reaction on the Novartis and Roche drug data as well that's coming out in that conference. So we're keeping an eye on a number of those stocks, and we are seeing green pretty much across the board in that sector, giving that update today. Then in terms of your chips, all very exciting with the AI impact from Nvidia. That is going to change the world, according to the CEO, who has been speaking about a new industrial revolution in AI, and that is boosting all of those stocks, as we did expect pre-market. So we're seeing ASML, BE Semi, Aixtron, and a number of others gaining today. Then we're going to flip over to football. Kriti is very excited about Kylian Mbappe moving club, but take a look at poor old Borussia Dortmund, down 7% after losing the Champions League final at the weekend. They were so close to getting a goal in the first half. They couldn't quite get it, and Real Madrid punished them. They miss out on €15 million worth of prize money because of that. They will actually get a bit of a bonus from the Jude Bellingham transfer, though that will take the edge off. But nonetheless, Borussia Dortmund down 8% following that loss at the weekend. Then we got a couple of morning calls to bring you. One of them in the UK, Financial St James's Place. JP Morgan likes this one. They say that a sell-off due to some regulatory changes around giving consumers fairer returns on their investments has gone too far. They upgrade to overweight, and that one gained 6%. But going the other way is Commerzbank. This one is in Germany. They get a downgrade because the fading interest rate rises will start to weigh on their net interest income, according to analysts at Citi. Commerzbank going the other way. That one's down 1.3%. Over in Germany this morning.
All right, Joe Easton from our equities team, we thank you for those movers. 8 minutes into the open, the stock 600 high at 0.9%. But coming up on the programme, we're going to go to Dubai to the IATA AGM. Guy Johnson is waiting in the wings for us with the CEO of Air France-KLM. He'll give us his take on the state of the industry. That's next. This is Bloomberg.
Welcome back now. The president of Emirates says Boeing is still years away from a rebound, a turnaround, following a string of bad news that ultimately, of course, led to a change in the CEO at that company. Tim Clark spoke to markets today. Anchor Guy Johnson at the IATA conference in Dubai.
If you ask me, this will be a 5-year hiatus starting from now. So I don't think they will recapture their production lines on all aircraft types. This is a challenge to them at the moment, given the pressures they're under. So I think one step at a time.
OK, Tim Clark speaking to Guy Johnson, of course, on the ground at the IATA event in Dubai, where Guy is standing by now with another great guest. Guy.
Tom, thank you very much indeed. We are joined now by Ben Smith. He, of course, is the CEO of Air France-KLM. There's only one subject to kick this interview off with, and that, of course, Ben, is the Olympics. They're about to start. Are you ready?
I think so. It's a once in a lifetime event, at least in France. Last time was over 100 years ago. Spending a lot of time preparing, even before I arrived at Air France-KLM, which was 5.5 years ago. So I think it's going to be a great show. It's very exciting.
Everybody's very excited, but there are some concerns around queues at Charles de Gaulle. I talk to American friends, they say the queues are still fairly long there. There's concerns about what could happen potentially with strikes. The unions are still kind of rattling and potentially could cause problems. Are you confident that we're not going to see any problems emerging?
Well, we're not adding any more airplanes to our fleet for this summer. And most summers were well over 90% load factor. So in terms of number of customers that we're going to be flying through the two airports in Paris, CDG and Orly, not going to be an increased number of passengers. The flows will be different. We'll have less customers connecting and more customers originating or destined to Paris. But in terms of capacity and number of passengers, it should be about the same as last year.
Are people avoiding Paris? Are business travelers avoiding Paris during this period? Are you kind of seeing a different mix?
Definitely a different mix. We are seeing a reduction in the number of business customers coming in, but the summer, we always see that. This is right in the middle, end of July, early August. It's not a peak business period for us, but it is a lot of volume. So what we think and what we see is there's going to be a lot of pressure on the baggage systems because never have seen so many inbound customers. Those are the types of things that are concerning us. But the airport authority, they've done what we see is a very good job of preparing.
Are you worried about the unions?
Well, in France, it's always a focus on organized labor. We have a good relationship with our 17 unions, and a lot of them are excited as well. But with labor law in France, you've always got to keep the relationships up.
So it can't be ruled out.
It can never be ruled out in France.
Okay. You talk about what is happening with demand. What does the demand picture look like right now?
For the summer, it's strong. Our airplanes will be full, for what we're foreseeing. And we'll see how pricing works out. But volume-wise, there should be no issue.
So you bring up pricing. Some of the low-cost carriers, Ryanair obviously is the example everybody's citing at the moment, talking about maybe softer pricing over the summer, softer fares over the summer. Any evidence that that's going to be a similar story for you?
Well, at Air France, we're a predominantly long-haul carrier.
Yep.
So we're not a low-cost carrier. We do have our low-cost carrier at Orly Airport. But as far as Air France goes, the traffic that we're seeing globally in all of our segments is holding up it's quite strong. Now, for Asia, we're still not back to where we were pre-pandemic. We've got this inability to fly over Russia, which makes us less competitive than Chinese or Indian carriers. So we've held back putting in capacity that we had at the same levels we had before the crisis. Transatlantic's good, Africa's good, South America's good. But I hear some of the discount carriers in intra-Europe are not able to reach some of the increases in yield that they were hoping for. We're seeing a little bit of that, but our Transavia unit is in growth mode, so we're not in steady state.
What is holding you back right now? It doesn't sound like it's demand. Is it the availability of aircraft? We've spent a lot of time already at this conference talking about what's happening with Boeing and what's happening with Pratt & Whitney. Is that where the challenge lies right now? Is it the availability of staff? Is it what you have to pay staff? Where is the challenge that is holding you back?
It's a little bit of all of that. I would say at the base, it's not the ability to source staff for pilots or for cabin crew. We've got issues on the maintenance side. A lot of our maintenance employees left the industry. A lot of competition to keep maintenance staff. In France, we have Airbus, we have Safran, we have Thales. So there's a lot of opportunities for mechanics. So that is an issue for us. Airplanes, on the wide body side, we have the airplanes we need. Maybe 1 or 2 months late, that's not the issue. But I would say it's getting the pilots in the right seat because there is a lot of training. It's complex with the union rules that we have. There's little bits of things here and there. But we are, I would say, if you look at our capacity levels versus 2019, when you compare that to other European airlines, we're sort of at the top.
You talk about maybe a few aircraft being late. Are you holding on to any older aircraft for longer as a result of that?
A few. We have we've got 180 wide-body airplanes in the group. we've got maybe 5 or 6 that we're holding back a little longer, not just to keep a little bit of a reserve, but also older airplanes that were missing parts, which is an issue from some of our suppliers. We've got at least some extra airplanes for backup. I mean, that's one of the things I can add to our list of issues and getting everything back to where we were. Is in the supply chain, we are having trouble sourcing parts for interior cabins, for engines, that type of thing.
Let's talk about what's happening in the consolidation story. You've talked in the past about it being a must in Europe. Doesn't feel like the Commission kind of agrees with you that it's a must that we see consolidation amongst the European carriers. We're watching what's happening with IATA very carefully. It looks like Lufthansa is maybe struggling to get that deal over the line. Are you running the numbers on IATA? Would that be a fit, do you think, for Air France-KLM were the Lufthansa deal to fall apart?
Well, I think we are totally for consolidation in Europe. And when I say consolidation, I mean consolidation to compete globally. I think Europe is the most competitive region from a intra-Europe or intra-region perspective. I mean, there are so many low-cost carriers in Europe. There's no shortage of choice for consumers. Where I think the European Commission is focused on, which we think is wrong, is ensuring that European airlines can compete globally. We are, I believe, disadvantaged because we are not able to get the economies of scale or to be able to maintain a relevance compared to Gulf carriers, American carriers, and this is our concern. The focus that we believe is wrong. The focus should be, are any of these transactions going to diminish long-haul competitiveness? And we don't believe they will.
Just to come back to the IATA issue, I hear what you're saying about what the Commission's attitude is towards the approach they're taking, but are you still open-minded about any of these? We've got TAP, there's Air Europa, obviously Luis is pursuing what is happening there. You've got the partnership coming up with SAS. But are you still open-minded if, for instance, Carsten Spohr over at Lufthansa doesn't see that deal go through? Are you open-minded still about maybe pursuing some of the other options maybe you haven't looked at yet? Are you running the numbers on some of these other transactions?
Well, look, we run the numbers on any opportunity that we could see.
That includes IATA.
Could be financially accretive. The former Alitalia or ITA, we had an investment in them twice.
Yeah.
KLM did, Air France-KLM did. Neither one of them worked out. We looked at it a third time. It's a difficult market when you look at the 2 airports in Milan. You look at Rome. There's a lot of foreign competition in Milan. If there was a business case to be had, I think we would be pursuing it a lot harder. Now, for our friends or our competitors at Lufthansa, it's a different dynamic. They have a different presence in northern Italy. The business case, I assume, I mean, we're not going to see the numbers. I assume is very different to our own.
It sounds like that's kind of still a no at this point. It would be a hard thing for you to get to work.
We walked away from it.
Yeah.
We did pursue SAS. We're very happy with how that's developing. It's exactly what we were expecting. We have a fantastic relationship with our partners who are co-investing with us, and we want to see that through. We don't want to take on too many things at the same time. As you brought up, there are going to be other opportunities in Europe. So we'll get SAS hopefully completed, and then we'll keep an eye out if there are any other interesting opportunities for us.
TAP would be a more logical transaction for you, do you think?
We'll see. I mean, the new government there, it was a big decision made that we were waiting for, and that was the decision to build a new airport.
Yep.
And we'd like to know, what is the transition period going to look like? Will it be both airports remain open, or will the old airport, the existing airports, close? That's very important for any particular this type of transaction.
Ben, it's always great to catch up. Enjoy the Olympics. I know you're going to be at the opening ceremony. I'm sure that's going to be
great.
Absolutely fantastic. Ben Smith, the CEO of Air France-KLM. The bell is ringing pretty. Back over to you.
Guy Johnson there with us. He said the CEO of Air France-KLM pushing him on what that consolidation may actually look like. He's a fan of it, but to what extent is he actually looking at that IATA deal? We'll bring you more headlines as we get them. Guy also spoke to the IATA Director General, Willie Walsh, who weighed in on the state of the consumer. Take a listen.
I don't think we've plateaued in terms of profitability or revenues. I think the issue for us is, we're still in the recovery phase from a financial point of view. There is more work to do, and I think there's good opportunity for the industry to move forward. We clearly have some challenges. Fuel costs remain stubbornly high. We're looking at a fuel bill of $291 billion, 31% of the cost base. That's higher than the normal, which we would normally sort of figure at around 27%. So we continue to see some issues there. But I think we're going in the right direction. Our industry is not one that is highly profitable in margin terms. So the best we've ever done was a 5% net margin in 2015 and 2017. So this year we're looking at 3.1%. So I think you can say there is further room for growth in the margin, but a lot of work that needs to be done.
What about further room for growth in demand?
The demand environment, I think, remains quite robust. You will hear comments from certain CEOs about slight softening in demand, particularly in the leisure markets. But I think demand, if we're realistic, is higher than we would have expected it to be. And the outlook in terms of certain markets which are still in recovery. So international travel from Asia is still recovering compared to where it was in 2019. And I think there is still scope for that to grow. Now, it's recovering slower than we had expected, principally because of the Chinese market in terms of international travel to and from China. But I think that's a timing issue, not a plateau. I think that market will continue to recover and get back towards 2019 figures, but it'll take a little bit longer than we had expected.
OK, that was Markets Today anchor, of course, Guy Johnson, speaking to the IATA Director General Willie Walsh at the industry meeting in Dubai. From airlines to the drug makers right now, GSK here in the UK taking a big hit in the session right now, down a full 10% on the news that a Delaware court has ordered that this company and others must face trial over allegations that its heartburn drug Zantac causes cancer. Of course, those are still allegations. GSK says it will appeal the ruling. Citi saying this could open up GSK to about 70,000 cases and potentially up to $3 billion in terms of costs around litigation. So that's from GSK, currently down a full 10% in the session.
We've also had the latest Spanish manufacturing numbers. The PMI for May, a beat on the expectation. It's 52.6% was what analysts expected. 54 a reading is what we have got here. No movement really in the euro off the back of this. No movement really in terms of Spanish yields off the back of this either. So I wouldn't say it really moves the dial for the ECB, this number. But an interesting read on the economy. We'll get the Italian manufacturing PMI at 8:45 London time for May as well.
And that just builds on the idea of that fiscal story that we continue to see, at least on the periphery, which really builds that outperformance. And speaking of that fiscal story, let's get some live shots here out of Mexico City here. These are from the campaign headquarters of former Mexico City Mayor Claudia Sheinbaum, who is now winning on that landslide victory. You can see that celebration there that we're keeping an eye on. Remember, she is inheriting a legacy, really, off of AMLO of fiscal debt, violence as well, not to mention the Pemex story that feeds into this region and really the global oil story as well. But you can actually see that already they are celebrating that victory quite aggressively. Whether or not that's actually showing up in the currency is a different story. You did see the Mexican peso initially strengthen on the landslide victory, but then pair some of its loss. Remember, the approval rating of her predecessor was at a 60% higher than you saw in any of the other leaders around the world. But of course, hitting that term limit, creating that opening for her. How she handles her presidency, what that relationship with the United States looks like under either a Trump or Biden presidency is yet to be seen. Coming up, we return to the markets with Aberdeen's Ben Ritchie to walk us through this equity story. That conversation next. This is Bloomberg.
We've been experiencing inflation for so long in general purpose computing. Now that we finally determined to accelerate, there's an enormous amount of captured loss that we can now regain. A great deal of captured, retained waste that we can now relieve out of the system, and that will translate into savings.
OK, Nvidia's CEO, of course, Jensen Huang, speaking in Taiwan on Sunday, talking about computational inflation, talking about the upgrade cycle as they look ahead, of course, to new products, new hardware and software coming through from Nvidia and eyeing the products that are going to be hitting the shelves next year as well. At this point, let's bring in a broader look in terms of the markets, but start on the technology segment with Ben Ritchie, head of developed market equities at Aberdeen. Ben, how are you thinking then about this upgrade cycle from companies like Nvidia and how you deploy capital around that? How potentially significant is the situation where every 12 months you get an upgrade from some of these big chip players?
Well, I think potentially it's very significant, and I think it's about trying to find the companies. I mean, many people describe Nvidia as selling the shovels to the AI industry, and perhaps it's finding the sort of maybe the handle seller to Nvidia or the other key components within that value chain that are going to be able to take advantage of that. And, you know, certainly when we look across Europe, there are some quite interesting plays on that. ASML, Bessie, you know, these are companies that are well positioned to help support and drive that. And they're going to be able to extract their fair share of value from that process as well. And
the valuation gap or the valuation story around some of those European names, do they make them more appealing versus some of their US counterparts? To what extent is the window open on the valuation story?
Well, I think it's all about delivery at the end of the day around these things. I mean, if you look at the multiples for a Bessie or for an ASML, they're not outrageous. And if the prospects which we expect to be delivered on the top line come through, then actually, you know, they could really look very, very good value indeed. I mean, particularly for something like Bessie, where you're in the early stages of changes in the packaging that they're offering, then potentially the growth opportunities longer term look really compelling. So, you know, it's not just about starting multiples, it's also about what the earnings growth is going to be.
And outside of tech, you prefer international equities over the US, if I'm not mistaken. Does that include the UK?
It does selectively, absolutely. I think it's very much the case when we look at it from a sort of standing back perspective. Is 65% the right amount of your capital to put into one market? Can you not find great opportunities around the rest of the world? And if you look at how the US equities have performed, then a lot of that has come from a small number of companies. It's just well documented. But it perhaps says, well, actually, what you really are looking for is to cover off your risk on the Nvidia. But what about the other 50%? Maybe that could be somewhere else. And we see, you know, really attractive company level opportunities in lots of other markets.
But what I kind of wonder about the UK is it because it's cheap or is it because of the fundamentals?
Well, I think it's always about the stock level opportunities. I think the connection between macro and micro tends to be pretty loose at the best of times. You know, the classic would be China, phenomenal economic performance for many years, terrible stock market performance. So I wouldn't connect UK macro performance with UK micro stock performance, particularly given the exposure to overseas markets, which is 75% of revenues. But there are still some really attractive opportunities within the UK. And I think it's just saying don't completely overlook a market just because you don't like the macroeconomic picture. There are going to be lots of really attractive opportunities within the marketplace.
Let's talk about one of those opportunities or potential not. Where do you stand on the defense sector? We're going into European elections this weekend. That's, of course, a major topic here. Is this something that is factoring into your playbook?
It's a question we're getting asked more and more, and we have a big focus on sustainability across our book at Aberdeen. So defence is a real live debate about how you're able to factor that into the footprint. And it's something, again, you know, there is a sophistication to that debate today which just wasn't there 12 or 18 months ago. The prospects for those companies look radically different today than they did in January 2022.
Yeah.
Companies like Kongsberg, BAE Systems, Thales, you know, the opportunities are definitely there. I think from that sustainability perspective, we just want to make sure that those weapons systems and services end up in the hands of the right places. And I think, to be fair, those companies haven't always done a great job of making that happen.
How does that compare? I'm going to tie this two together. What kind of racks my mind, it confuses me almost, that we see these massive valuations in the tech space. You're seeing it this morning, for example. The Nvidia read through, as Tom was talking about earlier, the likes of ASML, SAP, et cetera, with still no real clarity on how that kind of turns around and when that return comes from an investor standpoint. And yet, when on the defense sector, there's an active manufacturing ramp up, and yet you're not seeing them trade at the same valuations as tech companies, even in Europe, let alone the United States.
Well, I think there's some degree about how sustained that's going to be. I guess, you know, we've seen demand coming through. How long duration will that be? Will governments follow through on the spending commitments that they're made or that they might like to make? Again, I think there are, you know, the fiscal realities of that they are quite tied into that government spending. If you speak to, you know, perhaps I remember hearing Ben Wallace talk about that the UK needed to spend 3% of defence of GDP on defence just to make its existing kit work, and that's a 50% increase. Yeah. But whether it has that 100 basis points to actually spend is an entirely different question.
We were speaking to JP Morgan Private Bank earlier in the show, Zamzeef, and he was painting a pretty constructive picture of this global economy, saying that growth is actually starting to pick up. You've got central banks that are starting the process of cutting. The SNB is there. The ECB goes this week. And then, of course, we look to the Fed and the BOE. Maybe there's some divergence there. But this global economy, do you see the catalysts at play to keep this rally going?
Yeah, I think it's a finely balanced situation, I think, at the moment. I think you can certainly point to stability in economic growth. I think stability in European context is pretty good. We're starting to maybe see a bottoming in China, and we're seeing some good developments other places. I think you still, though, have to look to the risk in the US, which is that you do see that deceleration coming through with inflation higher that constrains policymakers in terms of interest rate cuts.
So stagflation in the US is a concern?
I think that's the biggest risk for market participants, for sure, because I think when you look outside of that, I think that scenario of discount rates coming down, inflation largely under control or moving in the right direction, and growth looking quite good. I think that cocktail looks pretty attractive across a lot of international markets. But there's no doubt that if we do see that sort of stagflationary development occur in the US, that's going to spook market participants across the board.
Do you want to just flesh out that view of China? Because you've mentioned it a few times. You had iron ore dropping on that China pessimism this morning. But, of course, the health of so many London-listed equities depends on the outlook for China.
I mean, China's a big driver for ex-US markets, absolutely. It's 15% of revenues for Europe. And again, I think it's important for sentiment for investors looking to put capital to work outside of the United States. I mean, it seems such a big part of that market. I wouldn't want to get overly excited about the domestic picture in China, but we've certainly seen the economy perhaps bottoming. We're seeing more substantive policy actions from government. We're seeing less aggressive action towards their own companies under the Common Prosperity situation. And I guess geopolitical issues around Taiwan, perhaps that's maybe being pushed to the left. So a number of those big negatives are perhaps not as significant today as they have been. And I think it's really just looking for that stabilization that would be helpful, that would underpin investment outside the US.
Rate cuts are traditionally a tailwind for the equity market. Is the one that's expected this Thursday out of the ECB priced in? Irrelevant? Where do you stand?
I think it's all about the direction of travel. I mean, we've already seen cuts in Sweden. We've seen cuts in Switzerland. We'll see the ECB cut this week, I'm sure.
Yeah.
I think it's about that dynamic. And can we set up a situation of interest rate differentials against the US, perhaps some currency weakening, perhaps that reduction in discount rate against the backdrop of stable economic outlook and decent earnings performance from companies? I think that is going to be a good cocktail for companies. So is that priced in? Probably not as it develops over the second half of the year.
But there's a concern, though, about whether or not this is a consecutive cut story, whether we go, say, a cut in June and then don't see one until September. How much of a difference does that make to the equity picture when you've got basically 3 months in between with no tailwind? What does that delay look like?
Well, I think it sort of depends on your time horizon. But I think the debate
on your
about
time horizon, what do you think?
Yes, so with a sort of kind of 3 to 5 year view, I think you can just sit back and be relatively relaxed, that you have broadly, to some degree, an asymmetric setup where you're going to see a number of interest rate cuts. We don't know exactly how many. Interest rate increases seem extremely unlikely from where we are. I think that's a pretty good setup for investors. And whether it's 2 or 3 or 4, however many it might be this year, the direction and the trend, I think, is supportive.
You've touched on the tech sector, and you've touched a bit on your regional preference. In terms of your sector preference, then, beyond tech, where does that lie, and what are you avoiding?
Yeah, I think we're always very sort of bottom-up, stock-led. But I think we still maintain something of a sort of pro-cyclical bias in our portfolio. It's really driven by where we see the best company-led opportunities. Sort of came into 23 with big overweights to consumer discretionary, industrials, financials, not so much to banks, but other parts within that space and tech. That was driven by stock-level opportunities and the earnings growth opportunities we saw there, rather than a top-down call. But that's kind of been the right place to be for the last 18 months. And we continue to see perhaps a little bit, as we've been talking about, a little bit more vigor, a little bit more confidence in the global economy that's made those places a decent spot to be.
OK, Ben Ritchie, thank you very much indeed, Head of Developed Market Equities at Aberdeen, with a view there on maybe how to position in this market. And a little bit of cautionary note I sense from you in terms of the global economy, but so far a few of those elements in place to possibly keep things going, but with a note of caution maybe around the US. Coming up, as 370 million people prepare to vote in this week's European elections, we're going to get a preview of what is at stake. Stay with us. This is Bloomberg.
I think lots of it is at stake.
This election is the most important election since 1979.
What is at stake is the future of Europe.
I think there are a lot of other issues too, like migration, the Green Deal, the competitiveness of the EU. But I think Ukraine will be the defining issue.
I do think that every nationalist party and sovereignist party in Europe are going to score.
What we are facing right now, if there is, for example, a surge of the far right, that the whole European project is basically going to be put in question.
So key figures from the EU's biggest political groups there underlying what's at stake in this week's elections to the European Parliament. Far-right parties aiming to make big gains in these elections when they go to vote on Thursday. 370 million people eligible to go to the polls across 27 countries. And the man who's going to be across all of it for us is our Bloomberg radio anchor, my co-anchor on the radio, Stephen Carroll. Lovely to have you with us, Stephen. Look, over the weekend I was looking at that massive rally for Viktor Orban in Hungary. Then you had the S&P downgrading France's credit rating and Macron already trailing Marine Le Pen in the polls. Just talk to us about how big a force the right wing is going to be in these elections.
Well, this speaks to the dual nature of these elections, because on the one hand, people are voting for the 720 members of the European Parliament, those people that will help shape the political and policy direction of the European Union over the next 5 years. On the other hand, people are voting in 27 different countries, so they're also dealing with competing issues at a national level. So what we're looking at when we try to examine what we take away from this election is both what people want out of the European Union, but also in a lot of cases what people want in their own countries. These elections are often referred to as being second-order elections by political scientists because people vote on issues that are not necessarily the way they would vote in a national election. In France, you mentioned, for example, a big focus on how Emmanuel Macron's party performs. It's seen as a bit of a midterm election for him, a check on the performance of his party and his popularity. But that also feeds into then the performance of the far-right groups, which at a European level operate in two distinct groups, and a big focus will be able to see how those two groups perform in these elections and what that means for the policy direction going from here.
Well, speaking of the policy direction here, it's a no-brainer that it's Ukraine, of course, this defense ramp-up. But we just had so many guests on our show this morning say that defense ramp-up isn't something the markets can really wrap their minds around because it just doesn't feel like there's enough budget for that. How does that affect the Ukraine story?
Well, it's a question of budget, but also a question of how the EU will decide to use its policy instruments to actually do something about it. It's important to remember that trying to get 27 countries to agree on anything is very difficult. And although the European Parliament has a co-decision power in forming EU law, ultimately a lot of the decision-making lies with the national governments. And when it comes to issues around defence, countries are very unwilling to try and cede that to a European level. So the issues that we should expect and what the major political parties in this election are promising is more action towards the defence industry, be it supporting production and ability to be able to ramp up production at a European level, inserting requirements that a certain amount of defence spending be done to purchase European-made defence facilities. There's already been £1.5 billion earmarked to work towards that. The need, according to the Internal Markets Commissioner Thierry Breton, is £100 billion is what he wants European countries to spend. The budget doesn't have that at the moment. They have to reallocate what's in the budget. That'll be part of the negotiations that happen after these elections. And the question of how much scale Europe can apply to this, given that it is an awful lot of money, that every country wants a piece of where that European budget goes, but they also have to make difficult choices about where to take it from.
So what are they fighting over? If there's no money to actually execute on this, what's the sticking point here?
Well, there is money, that's the thing, but it's a question of you having to make decisions. In the last Parliament, the big thing that we thought there wouldn't be a huge amount of spending on was health. The health budget was increased dramatically as part of the last budget negotiations. The question is, if you want to take money away from public health programmes, where do you put them to? Health isn't, under normal times, a huge expenditure level of the European Union. There's a question, too, about the next generation EU funds. This is part of the recovery fund that was built out of the pandemic. A lot of that money hasn't been spent. And if you're looking for more joint borrowing, for example, one of those always very tricky subjects at an EU level, it's a question of some countries, the so-called frugals, will be looking and saying, well, we haven't spent this other money that we've set aside for perhaps lots of reasons around it being difficult to access or is overly targeted to certain areas. So can they agree to reallocate those funds to something else? How do you do it? And then it feeds into the national playbooks as well. Certain countries want that money to be able to fund companies that are stronger in their own area.
So how does that debate change if we do get to this shift to the right that some are signalling on the back of this vote? Because you've got examples of Meloni in Italy who actually has, you could make the argument, moderated her views, her rhetoric, indeed her policies, precisely because she wants to get some of that budget. And then you've got the likes of the new Dutch leader, Geert Wilders, as well. A bit of moderation there as he puts that government together. But then the risks of Viktor Orban. So how do we think about the shift to right and whether or not these lawmakers are able and will adapt and maybe moderate or not? And to what extent that could be a sticking block as well, or at least a stumbling block maybe for the Union.
And thus you've perfectly outlined how European politics works.
Right.
Essentially, when we have the results of this election,
I think you did that.
Then we set. But look, this is what happens: is you set the ship on a course, and then you decide afterwards who the captain's going to be. And the first big vote is going to be: does Ursula von der Leyen, as she is seeking, get a second term as Commission President? The polls currently tell us that's quite likely. But who does she need to get into her coalition to get elected, because you have to be voted in by an absolute majority of the European Parliament. The last time around she only had a majority of 9, and that's despite the fact that actually if you put together the parties in her coalition, she had a much larger number than that, but it's a secret ballot, so not everyone in those political groupings will necessarily vote for the candidate that they're supposed to. So that's part of the horse trading that will go on behind the scenes. It's really controversial at the moment to see if Ursula von der Leyen and her EPP party will do business with the European Conservatives and Reformists, who are one of those hard right groups. The Socialists, who are part of the governing coalition, aren't happy about that. Renew, the centrist party, aren't terribly happy about it either. This is all what starts after these elections, and we know the makeup of the Parliament, where the direction goes next, what political direction that these policymakers want to set the EU in the direction of, and what that means in terms of who they do business with, who they try to deal with, and what support they try to win. And key concessions. The other thing to watch out for is a lot of these parties elected at a national level may switch allegiance after the elections in their European parties. There's a big debate over Viktor Orban's party and whether they will remember where they'll go, essentially, because they're not really seen as welcome in the EPP anymore. So who do they sign up to next? There's big splits within the far-right and hard-right groups as well. There could be some reshuffling in those groups too. I mean, we saw the AfD in Germany being expelled from the ID group, the group that Marine Le Pen's National Rally Party are part of as well. Part of this shifting political sands in Europe will be determined by how many MEPs these groups get, how they perform, and then the question of what sort of horse trading is done within those groups to say, you come over to my side and we might be able to do business.
Well, speaking of that horse trading, there was speculation about whether there'd be a top job for Mario Draghi, which brings me on to the ECB, because, of course, we're expecting a rate cut on Thursday to coincide with all of this voting. Pricing for a September cut fully priced now. How does that interact with the politics, the monetary story that's also happening in Europe?
It's interesting because we haven't seen the same necessarily political knobs that we've talked about a lot in the UK about how, you know, a Bank of England rate cut now is off the table because of the proximity to an election. It's not factored into so many of the decisions here, partly because of the fact that, of course, the European Central Bank is only the monetary policy maker for 20 of the 27 EU member states that use the euro. But the question, I suppose, more broadly is around the future of the European economy. Certainly, interest rates coming down would be welcome. Nobody between Thursday when that rate cut's happened and the 4 days over which voting is happening is going to see their mortgage costs come down, and they're going to suddenly think, oh, now I'm going to more likely to vote for X or Y party in the European elections. This is something that has, I suppose, a longer-term impact. It does point to an improvement in the European economy, but as is the story for decades now in the euro area and across the European Union, we're talking about relatively tepid growth. And one of the other big challenges going to be facing the next Parliament, the next Commission, is going to be how to try and reinvigorate that growth. Where do you leverage the European money? Where do you put it? How do you try and compete with the massive subsidies that are coming from the United States under the Inflation Reduction Act, or, of course, from China as well? It makes for a very difficult political landscape, but that theme of Ukraine is key to all of that. That's the one issue in all of the interviews that we've done in the run-up to these elections that every policymaker has talked about, the key nature of that, both from a big picture question of, the future of Europe, but also that key issue of where the defence industry goes next.
OK, Bloomberg Radio anchor Stephen Carroll with an encyclopedic take there on what to be thinking about leading up to that EU vote. Your comprehensive guide coming through from Stephen Carroll. Stephen, thank you very much indeed. Staying on the story of Europe, we're getting some data coming through from Italy in terms of manufacturing, PMI. Slightly softer than the April number, 45.6, in fact, for April, versus 45.6 versus 47.3 in April. So 45.6 is the May number versus 47.3. So it's a softening in terms of manufacturing. Of course, 50 is the line between expansion and contraction. So firmly in contractionary territory over in Italy when it comes to manufacturing. Euro dollar largely unchanged, currently at 108 on the single currency. Let's get back to the markets today. Anchor Guy Johnson now in Dubai at the IATA conference. Guys, some really interesting lines that you've been teasing out of your guests. And I know you've got a number of CEOs and executives still on the docket who you're going to be speaking to. What kind of has stood out to you in terms of where this industry is as it grapples with some of these supply chain issues?
It's not demand constrained. That is the takeaway. I think that is coming through loud and clear from the delegates here at IATA, which is interesting because there was a scare a few days back, Tom, when American came out and changed its guidance really quite significantly. That seems to be an isolated incident. Most of the people we're talking to here certainly seem to be of the idea that actually the consumer is still relatively strong, business spending is still relatively strong. Yes, I know we saw the data coming out of the States Friday indicating that maybe the consumer's retrenching a little bit. That certainly doesn't seem to be showing up in the aviation sector right now. The issue largely is one around what is happening with the supply side. Issues at Boeing, issues at Pratt & Whitney. We've just been hearing from Ben Smith at Air France-KLM talking about the fact that he's struggling to get the parts he needs to fix the aeroplanes to make sure that they continue to fly. So there's definitely a kind of supply side story which is still a big issue right now. It's a manufacturing story. You just brought us the manufacturing data out of Italy. So there is that story that is loud and clear right now, pretty much with everybody we're talking to. But the demand side is really, really strong. And the question is, how much longer does this continue for? And that's a really pressing issue right here in the Gulf right now. How cyclical are we seeing this industry being going forward? Are we going to see a downturn coming through? Is this the right moment maybe to IPO some of these big Gulf carriers, particularly at a time when we are seeing the financial markets really beginning to move into a higher gear here in this region? It's a question that I posed to Tim Clark. I have to say, to Tim Clark over at Emirates, taking a maybe more cautious stance when it comes to that opportunity for an IPO. But Etihad, many people are speculating in this region as to whether or not Etihad up in Abu Dhabi could be the first off the block in terms of the major carriers here to go to market. So I caught up with the CEO. We did it in the last hour on this program, talking about this very issue. This is what he had to say.
Never an end game, right? It's just another source for us to raise capital. I mean, the mandate that we have from the shareholder is very, very clear, right? Run this company like you're running a company that is listed, that is a public company.
So you're ready for an IPO. So you're already in position.
We're working very hard to make it happen whenever is the time.
And Guy, your day's not over. You still have a busy day ahead. In our last 30 seconds here, walk us through your lineup.
So we've got Shai Weiss coming up from Virgin Atlantic. He tells me he's got some news he's going to break with us in terms of new routes that they're going to be running. He's also got some interesting ideas about Heathrow. We're going to be speaking to the CEO of Pegasus out of Turkey, a low-cost carrier competing with the likes of Ryanair. What kind of demand are they going to see over the summer as well? And we're going to be catching up with Scott Kirby. He is the CEO of United Airlines. We're catching up with him a little bit later on in the day. So we've got plenty more people to talk to right here at the IATA AGM. Guys, back to you.
Guy Johnson there on the ground. Of course, like he said, plenty more coming up in the next couple of hours. Not the only thing we're watching on our radar. Lizzy's going to Frankfurt for the ECB coverage. Tom and Anna will be manning the studio. I'll be in Berlin with Danny Berger covering Super Return. There's plenty of coverage in the days ahead. You do not want to miss it. Just some of a taste of the lineup we're going to get on this show. Lots going on. Lots market moving. More ahead. Don't go anywhere. The Pulse is up next. I think that's with me. This is Bloomberg.